Welcome to our latest podcast. My name is Elizaveta Gridneva, and today I'm joined by Heejung Kim, who is the managing director at Direxion. Heejung is focusing on Asia business development. Today, our discussion will be focused on Korean market, and let's dive straight to it. Heejun, can you characterize the movement in the Korean market in response to the ongoing Middle East conflict?
Yeah, sure. So the Korean equity market has experienced its wildest week so far. Since Monday was a holiday, the market didn't really react to the Iran headlines right away. But when it reopened from Tuesday, the Kospi dropped more than 18% in just 2 days. Wednesday alone was down 12.4%, which is now the biggest single day decline in the index history. Then, almost as if flipping a switch, the market bounced back yesterday with a 9.6% gain, and it's been moving between minus 3.5% to flat today. It's now almost flat. What makes all of this even more surprising is that the Kospi was up 48% year to date before this week, ranking among the strongest markets globally. So yes, it's been a great performer for months. The swings have been quite huge. And the way it traded this week really highlighted how the market is reacting much more to global headlines than to anything happening domestically.
Understood, yeah, quite volatile times. And why have Korean stocks responded so strongly to the deepening global conflict, you think?
If you think of how the economy is built, then it makes sense. So Korea is heavily dependent on imported energy, and it imports 98% of its fossil fuels from other countries, and of which about 70% of those imports pass through the Strait of Hormuz. When Iran threatened to block that route, Korea felt the shock immediately more than most countries, I think. Also, the makeup of the Kospi index amplified the move as well. Two companies, Samsung Electronics and SK Hynix, together make up almost half of the entire index. So when oil prices jumped and investors started worrying about inflation and the energy demands of AI-driven data centers, semiconductor stocks got hit right away, and especially memory chip names went down quite a lot. If you think of Micron in the US session on Tuesday, it sold off sharply and ended the trading day with more than 7% loss. So Samsung and SK Hynix follow the same pattern. Shipping is also an important sector for Korea, and many shipping stocks fell more than 15%, especially those tied to routes that could be affected if Hormuz were to be closed. Even though shipping isn't as big in the index as semiconductors, the size of the drop added to the overall volatility this week.
Understood. And let's shift away from the news towards Korea market in general. Can you characterize the Korean retail investors' typical profile? What do they trade?
Yeah, Korean retail investors are very interesting and are incredibly active and also pretty bold. Among Asia markets, Koreans consistently rank among the heaviest traders of US equities, leverage ETFs, crypto, and other various derivatives. There were times when Korean investors accounted for 30 to 40% of the volume in certain US leverage ETFs, not Korean, and close to 40% of global crypto trading volume. Especially for the past couple of years, they were well known for trading US leverage and inverse ETFs, whether on semiconductors, US treasuries, or big American names like Tesla and Palantir. For us, Direxion, as one of the biggest leverage ETF providers, we've been watching how Koreans are trading these instruments. And more recently, there have been strong demands in sectors like energy, technology, AI, and semiconductors. These leverage and inverse ETFs, LNI ETFs, are short-term trading vehicles by design. And for active retail investors globally, these have been useful tools to trade in both upside and downside markets. And Koreans were some of the most active in this space. And more recently, as the Kospi started to outperforming and the government introduced tax incentive for converting US investment gains back into Korea won, some money has shifted from US stocks back into Korean equities. But still, Korean retail investors hold more than 150 billion USD in US stocks. So the overall overseas position remains still very strong.
That's very interesting. Thank you for the insights to Korea market. And what do you think what's next for the local Korea market? Will it continue to outperform for the foreseeable future?
It's always tricky to talk about what comes next without crossing into predictions, especially with macro events like the Iran conflict right now, which are inherently unpredictable. But there are some supportive elements for the Korean market right now. First of all, the government has been very clear about wanting to strengthen the equity market, and they are backing that up with actual policy changes. Real estate has always been the dominant asset class in Korea, and policymakers are actively trying to shift more wealth from the property market into equities by adjusting tax rules. And they also worked with the ruling party to pass reforms aimed at reducing the Korea discount, including the new requirement for companies to eventually retire treasury shares instead of holding them forever or being used in wrong ways, such as for leadership succession. These steps have created a stronger sense of confidence among both Korean and foreign investors by showing that the government is committed to make the market more transparent and more investor friendly. And at the same time, many research firms and investment banks remain constructive on the memory chip cycle. And since Samsung and SK Hynix are such a large component of the index, any strength in their share prices naturally have a big impact on the Kospi. Wrapping up, the outlook is positive and promising, but again, the market has been very sensitive to global news. So how things evolve will depend largely on broader developments rather than domestic ones. And as the index has skyrocketed for the past couple months, investors should invest carefully in Korea given the huge volatility right now.
Yes. One last question for you, Heejung, now on a separate topic. I actually would like to hear your thoughts on recent China announcement that it has set a lower growth trajectory for its economy. How might investors respond to that?
So it's expected that China is setting its lowest growth target in more than 3 decades, projecting 4.5 to 5% GDP growth for 2026. And it's a clear signal that its economy is slowing down, and it reflects deep domestic issues such as a collapsing property sector, persistent deflation, and weak consumer demand. But the market reaction to this news is minimal. Like Hang Seng Index is up 1.7% right now, and CSI 300 index is also positive with 0.3% up. It looks market is not really caring about it, and there are not many headlines about this right now. So it looks market seems familiar with the lower GDP target from China already, and as there are way bigger issues right now, Iran issue is a bigger problem to worry about. So people really don't care about this GDP news, I think.
Thank you for joining me today. And if you enjoyed today's episode, please subscribe to our channel wherever you download your podcasts from.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, as necessary, seek professional advice. Trading in digital assets, including cryptocurrencies, is especially risky and is only for individuals with a high risk tolerance and the financial ability to sustain losses. Eligibility to trade in digital asset products may vary based on jurisdiction. Complex or leveraged exchange-traded products are complicated instruments that should only be used by sophisticated investors who fully understand the terms, investment strategy, and risks associated with the products.